Yesterday, a single filing landed on a desk in Ottawa that fundamentally recalculates the math of the North American Trade Alliance. The document details a precise economic sequence: the immediate distribution of a massive taxpayer-funded stabilization package, followed almost immediately by a sweeping contraction of the domestic workforce it was meant to protect. This specific outcome establishes a pattern where capital interventions by a sovereign state fail to buffer local labor markets against rapid geopolitical shifts. The timeline behind this development is short. In March 2025, Washington imposed a 25% tariff on Canadian steel imports, a penalty that doubled to 50% within months. Because Canada historically operated as the single largest foreign supplier of steel to the United States, the sudden closure of this market dropped sales at regional anchors like Algoma Steel by 13% in a single quarter, incurring a direct tariff penalty of $89.7 million. Ottawa and the province of Ontario responded in September 2025 with a combined $500 million emergency financing package intended to preserve operations in Sault Ste. Marie, a community of 72,000 residents. Yet on December 1, 2025, exactly 2 months after the capital injection, the company issued 1,000 immediate layoff notices, effectively cutting 1/3 of its total workforce. That sequence is not coincidental. It is a direct policy statement on how international trade penalties alter internal corporate timelines. Algoma Steel had designed a gradual, multi-year modernization strategy to transition from traditional blast furnaces to automated electric arc furnace technology by the year 2029. This technological pivot naturally required less manual labor, but the original multi-year schedule allowed regional labor pools sufficient time to adjust. The imposition of the 50% export penalty made the existing blast furnace operations financially unsustainable immediately, forcing corporate executives to accelerate the closure of older facilities by an entire year. What that shift demonstrates structurally is that while state subsidies can successfully finance a company's technological survival, they cannot artificially maintain obsolete manufacturing positions when a primary export market vanishes. This structural exposure extends far beyond a single facility in Northern Ontario. The United Steelworkers Union, which represents more than 20,000 industrial laborers across the country, confirmed that mass layoffs spread across the broader manufacturing sector within 37 weeks of the initial trade restrictions. This 37-week window represents the entire operational runway available to capital-intensive industries before supply chain pressures force headcount reductions. The speed mismatch between immediate trade enforcement and multi-month diplomatic negotiations ensures that regional employment bases suffer long before legislative relief can materialize. This lag effect explains why the $500 million emergency lifeline, finalized in late 2025, arrived only after deep systemic damage had already compromised the company's balance sheet. The geographic concentration of this vulnerability magnifies the local impact. The primary metal manufacturing sector generates approximately 6% of Ontario's total manufacturing gross domestic product, with nearly 80% of its total output bound for United States ports of entry. In manufacturing centers like Hamilton, where more than half of the province's steelworkers reside at operations run by major producers like Stelco and ArcelorMittal Dofasco. The disruption of these cross-border channels triggers systemic regional downturns rather than isolated corporate adjustments. Individual secondary operators, such as shredder and scrap metal facilities in Eastern Ontario, experience immediate termination of contracts as domestic primary demand declines. These micro-level contract cancellations accumulate into macroeconomic indicators, validating the early warnings issued by labor organizations that a major disruption to cross-border access would impact a significant portion of the industrial workforce. The broader macroeconomic data from mid-2025 confirms that these manufacturing losses quickly rippled into national employment metrics. In July 2025 alone, the national economy shed 40,800 positions, a contraction that eliminated previous labor market gains and drove the national unemployment rate toward the mid-7% range. This trend disproportionately affected younger demographic groups entering the industrial workforce, with youth unemployment rising to 14.6% during the same period, while the national service sector offset these declines on paper by adding 85,900 positions, primarily within healthcare and social assistance. This aggregate data obscures a profound regional demographic challenge. Given that nearly 30% of primary metal manufacturing workers in Ontario are over the age of 50, the rapid elimination of specialized industrial roles creates long-term structural displacement. As older manufacturing laborers cannot easily transition into service-oriented fields, the federal response to this domestic contraction focused heavily on trade countermeasures and market insulation strategies. The administration implemented a $29.8 billion retaliatory tariff framework, penalizing $12.6 billion worth of American steel imports and $3 billion worth of aluminum products entering the country. To protect the domestic market from being flooded by displaced global supply, Ottawa simultaneously deployed a strict tariff rate quota system designed to force local manufacturers to source raw materials internally. These protectionist countermeasures, however, introduced a secondary domestic tax, driving up production costs for local businesses reliant on specialized American alloys. This retaliatory dynamic effectively increased overhead costs across the entire North American supply chain, demonstrating that defensive trade policy frequently penalizes domestic consumers while attempting to discipline foreign competitors. At the same time, shifting demographic variables within the country began altering how these economic pressures reflect in official statistics. National population growth slowed significantly throughout 2025, driven by the first meaningful decline in net migration in decades. This reduction in the volume of incoming labor market participants artificially dampens the reported unemployment rate by shrinking the overall denominator of active job seekers. Consequently, the apparent stability of national labor statistics masks the true severity of industrial job losses, complicating the analytical framework required to assess real economic damage. This demographic shift means that standard employment reports no longer offer a precise reflection of regional industrial health. This brings the structural analysis back to the long-term prospects of regional manufacturing centers like Sault Ste. Marie and Hamilton. Algoma Steel continues to advance its electric arc furnace installation, targeting full operational status within the year. While this transition satisfies the requirements of the $500 million capital injection and secures the long-term viability of the corporate entity, the new automated infrastructure permanently requires fewer personnel to operate. What this outcome reveals is a permanent decoupling of corporate profitability from community employment stability, as the accelerated adoption of automated technology permanently erases the high-wage industrial roles that previously anchored the regional economy. But the more consequential question, the one that sovereign manufacturing economies globally are watching with intense strategic scrutiny, is how this structural vulnerability will reshape industrial policy across other highly integrated trade corridors. The core tension established by this industrial crisis rests on the direct collision between state-level financial intervention and the velocity of external trade friction. While the distribution of $500 million in joint federal and provincial aid successfully shielded the corporate identity of Algoma Steel from immediate insolvency, it completely failed to insulate the regional workforce from the immediate impact of a 50% export penalty. This systemic divergence demonstrates that under modern protectionist conditions, public capital can preserve industrial assets and accelerate technological transitions without maintaining the local employment baselines that originally justified the state intervention. The emerging strategy reveals that sovereign subsidies frequently function as an unintended bridge to automated manufacturing, rather than a defensive shield for industrial labor. This operational reality became clear through the specific execution of the corporate restructuring plan inside the facility. Corporate data shows that the direct tariff expenditures of $89 $0.7 million systematically depleted the working capital required to maintain simultaneous operations of legacy blast furnaces and the construction of new electric arc infrastructure. To stabilize its balance sheet, the executive leadership accelerated the permanent decommissioning of the carbon-intensive coke-making and blast furnace units by approximately 12 full months, moving the operational timeline directly into early 2026. This tactical acceleration reveals that when access to a primary external market is restricted, capital optimization requires the immediate elimination of secondary labor-intensive production processes to protect core asset value. What this shift implies structurally is that the regional economy must now absorb a permanent contraction of its industrial job base years ahead of schedule, fundamentally reducing total household income across the municipality. The strategic calculations behind this shift are further clarified by the official justifications issued during the initial capital allocation phase. When the Emergency Stabilization Fund was finalized, the policy framework was explicitly presented as an intervention to maintain regional employment continuity through an acute trade disruption. Industry Minister Melanie Joly stated that Canada would support the steelmaker fully, a position that signaled a deliberate administrative commitment to utilize public credit to buffer private corporations against foreign regulatory actions. This public posture, however, revealed a profound miscalculation regarding the capacity of sovereign capital to offset a structural collapse in consumer demand from an integrated trading partner. That official policy stance ultimately prioritized corporate continuity over payroll preservation, indicating that future state interventions in trade-exposed sectors will likely focus on capital retention rather than localized labor stability. The systemic failure of this defensive subsidy strategy forced an immediate escalation in Ottawa's broad, our macroeconomic approach, shifting the focus from corporate insulation to aggressive market retaliation. The administration enacted a $29.8 billion retaliatory tariff schedule, imposing a $12.6 billion penalty on incoming American steel products and a $3 billion tax on foreign aluminum imports. This aggressive counter-intervention was designed to create an artificial domestic demand enclave by utilizing a strict tariff rate quota system to penalize foreign supply that exceeded historical baselines. This retaliatory mechanism, however, immediately increased intermediate input costs for domestic manufacturing entities, reliant on specialized cross-border alloys, functioning as a secondary internal tax on production. This legislative dynamic indicates that the domestic manufacturing sector will face escalating overhead costs, potentially triggering secondary contractions across downstream automotive and industrial equipment supply chains throughout the year. The domestic disruption contrasts sharply with the immediate performance metrics reported across the border within the protected market. Throughout late 2025, major American producers, including United States Steel Corporation and Cleveland-Cliffs, reported a substantial expansion in domestic order books and improved capacity utilization rates across their manufacturing facilities. This divergence demonstrates that a 50% protective tariff operates effectively on its narrowest intended metric, successfully redirecting domestic procurement toward local supply chains by raising the baseline cost of foreign alternatives. This protectionist advantage, however, carries a documented macroeconomic penalty, as independent data from the Tax Foundation demonstrates that the broader tariff campaign introduced a systemic annual cost of approximately $1,500 per American household, while reducing long-term gross domestic product. What this cross-border imbalance demonstrates is that protective trade policies do not eliminate economic friction, but rather redistribute the financial penalty away from domestic producers and directly onto consumer populations through inflated retail prices. This redistribution of economic pain is heavily governed by the rigid temporal structures of International industrial procurement. In primary metal industries, supply relationships are stabilized through long-term delivery agreements that typically operate on strict 6 to 12-month contract cycles. This institutional delay means that while a tariff policy can be enacted instantly via executive decree, the full volume of layout contractions and factory idling lags behind the policy announcement until existing corporate purchase agreements officially expire. This specific operational lag explains why the mass labor reductions across the broader manufacturing sector materialized exactly 37 weeks after the initial Washington Declaration. This structural timeline implies that the current wave of industrial layoffs is not a completed event, but rather the initial manifestation of an ongoing contraction that will continue to compound as remaining multi-quarter procurement contracts face renegotiation under the current tariff regime. This reality has forced a profound strategic reassessment across other highly integrated manufacturing economies that share deep structural dependencies with the American market. The automotive and advanced manufacturing corridors of Mexico face identical structural exposures under the current Section 232 trade frameworks, while major industrial exporters in Vietnam, India, and the broader Asia-Pacific region are closely monitoring the Canadian precedent. The rapid dislocation of a highly integrated G7 trading partner demonstrates to global policy planners that historical defense alliances and comprehensive trade treaties offer no meaningful protection against the sudden use of targeted import penalties. This realization is driving a systemic shift in global industrial strategy, forcing sovereign governments to abandon single-partner export models in favor of aggressive state-backed market diversification campaigns. This structural shift means that international capital investment will increasingly favor manufacturing facilities that possess decoupled, multi-regional supply logistics capable of shifting delivery destinations within a single quarterly cycle. Meanwhile, the local mechanisms designed to manage the human cost of this transition are revealing severe operational limits within the domestic labor market. The provincial administration initiated specialized retraining programs explicitly tailored for the displaced industrial workforce in northern and western Ontario manufacturing hubs. These state-sponsored initiatives are structurally designed to transition manual manufacturing laborers into adjacent technical or service roles. Yet regional data indicates that older demographic groups face exceptionally low placement rates following comprehensive career changes. With nearly 30% of the primary metal manufacturing workforce in Ontario currently over the age of 55, the rapid elimination of long-term industrial roles frequently results in permanent labor force detachment rather than successful professional reintegration. This demographic reality means that localized retraining expenditures will likely yield diminished economic returns, leaving regional municipal budgets to navigate prolonged drops in local tax revenues and sustained increases in social assistance dependencies. This structural divergence is further complicated by the broader deceleration of national demographic expansion patterns observed throughout the current fiscal year. National statistical reports indicate that population growth slowed significantly over the past 12 months, marking the first sustained decline in net migration numbers in recent economic history. This contraction in the volume of incoming labor market participants alters the statistical representation of economic distress, artificially suppressing the reported unemployment rate by reducing the total baseline of active job seekers within the national calculation. Consequently, the apparent stability displayed in aggregate federal employment tracking masks the acute structural erosion occurring within specific manufacturing regions, creating a false signal of macroeconomic resilience. This divergence between national aggregate statistics and regional industrial realities means that federal policy allocations will likely remain misaligned with the actual severity of local economic contractions. The long-term resolution of this trade crisis now narrows to a single, critical structural variable that will conclusively dictate the survival of independent domestic manufacturing centers. The entire future viability of the Canadian steel architecture depends on the upcoming fourth quarter 2026 renewal dates for long-term cross-border automotive and heavy machinery supply contracts. an event that will determine whether domestic producers can successfully sustain operations exclusively on internal demand or if they will be forced into a prolonged, structural downsizing of their total industrial capacity. The complex intersection of capital subsidies, accelerated automation timelines, and retaliatory tariff architectures forces a clear, analytical distillation of this cross-border crisis. The sequence of events across the current fiscal year demonstrates that industrial insulation strategies cannot fully neutralize the structural leverage wielded by a dominant trading partner. When state interventions are deployed to absorb localized economic shocks, they frequently alter corporate operational behaviors, rather than halting the underlying market contraction. This integration of political and corporate strategy establishes a new baseline for how mid-tier manufacturing economies must calculate the true cost of trade interdependence going forward. For Canada, this development marks a forced reconfiguration of its foundational macroeconomic architecture. The long-term reliance on unimpeded access to the United States market has been replaced by a defensive model focused on domestic demand creation and aggressive product diversification. While capital stabilization packages preserve the physical infrastructure of national industrial anchors, the rapid loss of high-wage manufacturing roles permanently reduces consumer purchasing power across industrial corridors. Ottawa's primary strategic objective must now shift toward managing localized economic contractions, while attempting to secure alternative international delivery agreements that can absorb structural production surpluses across the border. The strategic outcome for the United States reveals a clear trade-off between protected domestic sector gains and broader consumer price inflation. While protective trade policy successfully expanded domestic order books and enhanced capacity utilization rates for American producers, it systematically exported structural financial penalties to allied supply networks. The implementation of near-universal import restrictions functions effectively as an isolationist mechanism, but it exposes downstream domestic manufacturing entities to elevated input costs and retaliatory foreign measures. This landscape forces Washington to continuously balance the preservation of its localized industrial production base against the systemic inflation introduced throughout its wider domestic consumer market. On a global scale, this trade conflict serves as a critical operational template for other major industrial export economies. Sovereign planners in Europe, India, and across the Asia-Pacific region are closely analyzing the speed with which historical trade frameworks and defense partnerships can be bypassed via executive decree. The strategic response from these international actors will focus heavily on accelerating independent supply logistics and decreasing their direct exposure to centralized consumer markets. This shift indicates that international capital allocation will increasingly prioritize geographic flexibility, effectively ending the era of single-partner export models in favor of highly distributed, multi-regional manufacturing corridors designed to withstand sudden regulatory shifts. Ultimately, the structural reality of this trade crisis reveals an uncomfortable pattern regarding the limits of state-directed financial intervention. Public capital can successfully finance a corporation's technological modernization, construct advanced automated facilities, and preserve a legal corporate entity on paper. But it remains fundamentally powerless to dictate terms to a closed external market. When a primary trading partner constructs a high regulatory barrier, the financial damage moves at an operational velocity that outpaces the deployment speed of government aid packages. This asymmetry ensures that industrial workforces bear the direct financial burden of trade disputes through immediate payroll contractions. Long before state-level countermeasures or regional retraining programs can achieve structural stabilization, the single most important takeaway from this industrial contraction is that in a highly integrated global economy, company survival and community employment stability have become entirely decoupled outcomes. State subsidies designed to protect workers frequently function instead as an inadvertent capital bridge to automated manufacturing, enabling corporations to accelerate technological transitions. that permanently eliminate the manual labor bases they were originally funded to save. When trade policy is weaponized to restructure cross-border supply networks, the long-term capital assets of a country may survive the transition, but the industrial payrolls that anchored its small cities are gone forever.